Okay. So we are now heading towards another of the examination questions, again from the SBR Practice Exam 1 on the ACCA CB practice platform. And this is going to be question number 3 from the SBR International Practice Examination available on the CB practice platform. The name of the question is about Skizer company. The name of the question is about Skizer company, which is actually a pharmaceutical company. Now it says Skizer company which develops new products, other pharma company that have appropriate production facilities. Following details are available. What are the requirements of the question? It says explain the criteria for the recognition of asset in IASB's conceptual framework for financial reporting, and whether the criteria in the are the same as IAS 38. Discuss implication of Skizer's financial statement for both the years. Ended 31st August and 2008, so and so, so and so, whether the proceeds of the development project are going to be taken there or not. Now there are these disclosure related things also. So we're going to talk about all of these requirements in this specific scenario. Let's just try to cover them up. Right? Okay, let's just start discussing this. Let's just start taking things forward. So we can just, because you see in the examination, there is another part of this question. Okay, here you go. It actually is one of the requirement is explain the criteria for the recognition of an asset. Explain the criteria for the recognition of an asset under what? Under the conceptual framework. Under the conceptual framework. And also what does it say? It says that whether the criteria are the same in IAS 38 intangible assets, that's one thing. So what pointers you can write on this? What pointers you can write on this? Okay, see what happens is that when we talk about this is 6 mark requirement. So even if you don't know about the conceptual framework in the examination, you could still get 3 marks. How? As per you could, I mean, like I'm just writing down the answer as if I don't know the conceptual framework, but I could say as per IAS 38, an intangible asset is allowed to be recognized if it meets all the following conditions. It meets the definition of intangible asset. It is probable that future economic benefits will flow to the entity. Cost of the asset can be measured reliably. With respect to the definition of the intangible asset, it is a identifiable non-monetary asset without physical substance. See, if I don't know the framework, what am I gonna do? I'm simply gonna write down things pertaining to IS 38. I'm not just gonna miss out the whole question. You got to capture marks where you can capture. You don't have to give up. You don't have to give up. Now, but I'll just let you know the criteria under the conceptual framework. So under the conceptual framework, an asset is a resource controlled by the entity and is expected to provide economic benefits to the entity in the future. The asset is recognized when its presentation would lead to faithful and relevant presentation to the users of the financial statements. Right? You get my point. Now, what actually happens now is that um, the criteria as per IS 38 intangible is so and so so. There is not much of the difference between the criteria laid down in the IFRS and the criteria available in the conceptual framework as the conceptual framework focuses more on faithful and relevant presentation and is more general in nature, whereas the IS 38 is specific about the intangibles. So this is where the major similarity is. This is where it actually is between the IS 38 and between this conceptual framework. Now, so this was one of the requirements. Then it says discuss the implications for Skizzer's financials for both the years ended 31st August 7 and 8 if recognition criteria were met as regards the stakes in the development projects. Your answer should briefly consider the implications if recognition criteria were not met. Now, can you just try to do this, please? Can you try to do this, please? Okay, let's see. It says when a Skizer company acquires a stake in the development project, it makes an initial payment to other pharma companies. It then makes a series of further stage payments until the product development is complete. Now, what happens is that first of all, it acquires a stake in the development project. Then it makes initial payment. It then makes a series of further stage payments until the product development is complete. Until the product development is complete. And it has been approved by the authorities. In the financial statement for the year ended 31st August 2007, financial statement for the year ended 31st August 2007, Skizer has treated the different stakes in the development projects as separate intangible assets. So what have they done? They have treated it as a separate intangible asset because future economic benefits related to the production rights are so and so, so and so. Okay, now see what happens is that um, so it says that until the product development is complete and it has been approved by the authorities in the financial statements for the year ended so and so. Skizer has treated different stakes in the development project as separate intangible because of anticipated future economic benefits related to Skizer's ownership of production rights. Now, however, in the year to 31st August 2008, the directors of Skizer company decided that all such intangible assets were to be expensed as research and development costs as they were unsure as to whether payment should have been initially recognized as intangible. This write-off was to be treated as a change in accounting estimate. Okay. 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 See, what happens is that discuss the implications for Skizers for both the years ended so and so if recognition criteria were met as regards the stakes in the development projects. Your answer should also consider the implications of the recognition criteria were not met. So what do you have to do? You have to basically talk about if the recognition criteria was met, what to do. If the recognition criteria was not met, what not to do. Now see what happens is that if the criteria for the recognition of the intangible asset is met, I repeat, if the criteria for the recognition of the intangible asset is met, then it should be recognized. However, if subsequently it is determined that the asset may not yield the benefits, then this is an indication of the impairment and should lead to an impairment loss to be recognized. And this should lead to an impairment loss to be recognized, right? Reversing the policy. Okay. This is not a change in the accounting estimate, but rather an indication of impairment, and instead of the IAS 8, IAS 36 impairment of assets should deal with this matter. In case if the recognition criteria was not met, then instead of the change in estimate, this must have been treated as the correction of prior period error. This should have been treated as a correction of prior period error and be corrected retrospectively. You get my point? It's not a change in estimate, it's an error. It's not a change in estimate, it's an error. If it's not meeting criteria, it's an error. If it's not meeting criteria, it's an error. Okay. Why are we mentioning impairment? See, what happens is that why do you want to change? You think that the asset is not meeting the criteria. If it was meeting the criteria and if it is not meeting, I mean, like, see, it says if the recognition criteria is met, but they think that no, we are not going to get the benefit now. So that means circumstances have changed. That's a cause of impairment. You should recognize impairment loss. Do you get it now? Yeah, Gladys, do you get it now? Right now. Then there is this another area. Okay, see, if you think that it is like you had an asset that met the criteria, and now think that we should not be recognizing it, that means it's an indication of impairment because there is some information which you have got, which helps you, which is actually indicating to you that it is not going, it should not be recognized now. Now, it talks about another area which is the sale of the development project. Can you go through it now? Can you go through this now? Okay, see, it says on 1st September, Skizer acquired a development project as part of the business combination and correctly recognized the project as an intangible asset. So you acquired a subsidiary and you had a development project, you recognize it as an intangible asset. However, in the financial statements to 31st August 7, Skizer recognized impairment loss for the full amount of intangibles because of the uncertainty surrounding the completion of the project. Okay. During the year ended 31st August, the directors judged that it could not complete the project on its own and could not find a suitable entity to jointly develop it. Thus, Skizer decided to sell the project, including all rights to future development and so on, so on. Skizer company Skizer company succeeded in selling the project, and as the project had a nil carrying amount, it treated the sale proceed as revenue in the financial statements. So they treated the sale proceed as revenue. Directors argued that IFRS 15 states that revenue should be recognized and the control is passed at a point in time. The directors argued that sale of the rights was part of their business model and that the control of the project had passed to the purchaser. See, what are the issues in here? What are the issues in here? How many marks requirement? 4 mark requirement. So basically that means the 4 points have to be discussed, and we need to majorly talk about 31st August. So you need to explain what is revenue, discuss why this is not a revenue, explain that it is a disposal, explain that it is a disposal of asset and not the recognition of sale. This is the disposal of asset and not the recognition of sale. Right? So you have to explain to them that look, what is the concept of revenue? The revenue is what? Revenue is the inflow from the ordinary course of business. What is revenue? Revenue is the inflow from the ordinary course of business. The main business is to, what is the main business? Let's just discuss a bit here. Uh, okay. The main business is to develop products and not to sell the patents or the development assets. Therefore, the sale of our development asset is not to be considered as the ordinary activity and rather a one-off activity. the revenue recognized shall be reversed and rather a gain slash loss on disposal is to be recognized. Since the revenue shall be reversed and rather a gain or loss on disposal is to be recognized. Now say since since the asset had a carrying amount of nil, therefore the entire proceeds are the gain on disposal and should be recognized in the income statement accordingly. Right? Is that okay? Yeah, is that okay now? Okay. So now let's move to the next part of the question, which is part B, and let's discuss that what exactly is there in part B. Anyone would like to add up anything to this part A3? Anyone would like to add up anything to part A3 answer? The write-off of intangible assets is okay. I mean, like if you think that they do not meet the criteria for capitalization, then write them off. That's okay. Write-off should not be an issue because you see, you think that it is not worth it, you write it off. You think it's not gonna give any future economic benefits, you write it off. Because you see, the circumstances may be different when you wrote it off, and the circumstances may become different at a later stage. So things could change. Right? Okay. Next, we have got this part: external disclosure of information on intangibles is useful only insofar as it is understood and is relevant to investors. It appears that the investors are increasingly interested in and understand disclosure relating to intangibles. A concern is that due to the nature of disclosure requirement of IFRS, investors may feel that the information disclosed has limited usefulness. They are making comparisons so and so, so and so, so and so. The integrated reporting framework may be one way of solving the problem. Okay, this is what they have mentioned. Now see, what are they mentioning in this requirement? Discuss the potential issues which investors may have with accounting for different types of intangible assets acquired in business combination, the choice of accounting policy of cost or evaluation allowed under IAS 38, and the capitalization of development expenditure. So see, it says discuss potential issue which investors have with accounting for different type of. So what are the three things that we have to talk about? We have to talk about the accounting for different type of intangible assets. Then we have to talk about the choice of accounting policy. Then we have to talk about the capitalization of development expenditure. Now you know what? The exam is easy. If you know the accounting standards, believe me, exam is easy. But you know, where do we go wrong? We go wrong because we get confused. You see, if somebody is going to read this whole part, he's going to be like, oh my God, what is he asking? But believe me, he's not asking anything difficult. Even if you don't know anything about integrated reporting, that is only 3 mark here. That is only 3 mark here. The rest is about IS 38 intangible, you know it, and it's quite easy, quite simple. Just read the question and try to identify what is he asking. Just break down the requirement. Break down the requirement into multiple parts. Right now. So accounting for different type of intangibles acquired in business combination, what happens is that these intangibles to be identified, measured at fair value. If fair values are not determinable at acquisition dates, then these should be included within the goodwill. The choice of accounting policy and out, lack of active market, whole class of intangible to be measured using same model, usually difficult to find active market and hence fair values over the entire life of the intangible. Right, so the fair values are difficult. Now capitalization of development, demonstration of the criteria being met is quite subjective. Again, you don't have to write down the answers like this. I'm just listing down the pointers to make things easy for you. You don't write down the answer like this in the examination. In the examination, it has to be short paragraphs. In the examination, it has to be short paragraphs. Right? Okay, demonstration of whether the criteria met is quite subjective. So one thing is that the demonstration of the criteria being met is quite subjective. Plus, allocation of expenditure into the research and development phase would require judgment. Right? So these are the few pointers that you are gonna do. Now it says discuss whether integrated reporting can enhance the current reporting requirement for intangibles. What happens under integrated reporting? The value addition is analyzed. Discussion how different assets have created value for the organization. Value addition is analyzed. Discussion of how different assets have created value for the organization. So hence what happens is that hence the overall disclosure would be enhanced. So basically what happens is that when you are doing a question, you have to be very careful, and you have to make sure that you actually list down things and you write according, right? Okay. So we are done with this question also. That was about Skeezer company. That was about Skeezer company. Okay.